Good morning, folks. So, the 6 things that I want to speak to you all today are these: the Israel-Iran conflict that has erupted last night, the InvIT program of the National Highways Authority of India, inflation again, and what to do with small and mid caps, what's happening with Power Finance Corporation's bond issue, why is it being withdrawn every time, and the last item would be silver and how does one look at it. So let's get on with it, folks. So unfortunately, we opened this week's podcast with another conflict issue. It so happens that last night Israel has attacked Iranian nuclear facilities, and 2 of the nuclear scientists are dead, and the chief of the Iranian Revolutionary Guards is also dead in the attack. And obviously Iran will not be sitting quiet. There would be retaliation, and the retaliation would be pretty severe, and that is the worry for the rest of the world while Israel and Iran are fighting out their battles. So the first thing that happened as far as the markets are concerned, oil shot up. Iran is a large producer of oil, and in fact it has been producing more than what OPEC has been telling it to produce. And if there is conflict there, obviously Iranian oil supply will cut down. So overnight, oil has shot up by almost 10%. It's about 9.5% as I saw last before the podcast, and could very well go up more if the conflict deepens. It's a big worry, and you can expect it will hit inflation for oil importing companies with this kind of a jump in oil prices. Okay. Stock markets, of course, down. They are worried. And stock markets in Asia that have opened post the news of the conflict are all down by about 1%. And the European market futures, US market futures are all pointing to downward 1 to 1.5% from yesterday's lows. Okay. Gold is up, naturally. It was quiet for most of the week, but as news of the conflict broke out, gold also shot up by almost 1 to 1.3%. And let's see what happens as the week goes by. Apart from the kind of impact on the financial markets that the conflict would have, let us remember that the Straits of Hormuz, which is outside Iran and controlled by Iran, is a critical shipping lane. And even when we had the conflict, the rebels in Yemen threatening the route, it created a lot of chaos, and war with Iran could also create a similar chaos on these shipping lanes. It will disrupt logistics if it so happens, because the last time when this happened with the rebels in Yemen threatening shipping lanes, cargo ships had to go all around the Cape of Good Hope, all around Africa, to reach Asia from Europe, or from Asia to Europe. And that took up freight cost by almost 30% because of the extra distance it had to travel, fuel and time taken. Both impact freight costs. And that is something for us to be worried about. Let us hope it comes to a quick close without too much damage, but that is really hoping too much with two strong nations. It's a veritable tinderbox, and I'm just hoping the rest of the Middle East doesn't get drawn into this. Okay, so let's hope for the best. And as we go into the next topic, it says that the National Highways Authority of India is looking to raise 20,000 crores via 2 rounds of InvITs. So what is this InvIT? An InvIT is an investment vehicle designed to own and operate infrastructure assets. Okay, and units of this trust would be owned by either institutional or retail investors like you and me, and we could get the benefit of the income being generated by these assets. So in this case, what NHAI is doing is it's going to be offloading some of its highways to these trusts. It proposes to do 2 rounds of monetizing, as they call it, 20,000 crores. These highways go into an infrastructure investment trust, which will hold the assets, own the assets, and all the tolls that are collected by the highways, by the traffic passing through these highways, get distributed to the unit holders. So it's a kind of a regular stream of income that the investor can expect. The earlier the earlier investment opportunity through NHAI's InvITs were as bonds. I am just hoping that this time around it is not through issuance of bonds, but it is through sharing of the revenue, which has an upside, obviously. Let's see as the details come out what happens. The SEBI regulation states that at least 85% of the revenue or the cash flow has to be distributed to unit holders. It's a good. Every quarter, one can expect a payout to every unit holder consisting of dividend or interest or etc. And it can be a dependable form of income with maybe minor variations here and there. And this also works just like a real estate investment trust, except that here the assets are infrastructure assets. In this case, it is highways. In the case of other InvITs, it could be power transmission lines or power plants, so on and so forth. Why do companies do it? Why is NHAI doing it? It's going to be spending about 2.5 lakh crores on building new highways. So it needs resources. One of the ways to raise these resources is to sell its existing assets, existing highways, raise money and use it to build roads, new roads. And in a future time, sell away those roads, raise money, and the cycle continues. This is a great way of directing resources to fresh assets rather than say, I don't have any money, I'm not going to build any new roads. This is a great way of doing it. It is very popular around the world. And as India goes into this capex cycle, we also have been doing this. Then we come to news about retail inflation. So the headline says that retail inflation cools to a 6-year low. The latest reading is 2.82% only, way below RBI's target. So all of last year, inflation was higher, and part of it was because of food. And as food prices, vegetable prices, fruit prices fall, retail inflation is falling. It's come to only 2.82%. This is good because prices are growing at a lower rate for us on the street. But also, I do think it is a reflection of the demand scenario. Because demand is a little weak on consumption, it is possible that retail inflation is also at this kind of a low. We do have industry leaders talking about the slow pace of urban consumption. We spoke about it last week too, that urban consumption grew lesser than rural consumption. And more voices are coming out to say the same. A recent Cantor report that I read had a very interesting observation. As far as urban consumption is concerned, it said that their urban population are more willing and have been buying more of unbranded goods than branded goods. So if you're seeing a low top line growth for the FMCG companies, it is because that a number of people are willing to buy unbranded goods. Whereas the rural population is still buying branded goods. They buy branded goods because they aspire to be like their urban peers. And urbanites are saying, it doesn't matter, brand doesn't matter to me anymore. Okay, so it's different stages. Let us see how it evolves, but consumption has not been great. We are hoping that consumption improves during this year. We've been speaking about this repeatedly through the podcast. It just means that we are searching, we are hoping, and for this to happen. There's also news that says RBI to bar offshore fixed deposits and limit the remittance rules. In the last monetary policy review, the RBI governor did say that they will be looking into the LRS rules and rationalizing them, optimizing them. This article speculates that possibly the RBI does not want the remittances to go simply towards fixed deposits with the shifting of wealth from here to there, and they may not want that to happen. Last year, about $31 billion of wealth flowed out of India through LRS channels to global investments. So while RBI doesn't mind Indians remitting out to buy assets. They don't want it to be put to idle use like just being in bank deposits. Fair enough. I think that's okay. Let it be productive, whatever we do, right? Let's come to this small and mid cap dilemma, as the headline says. Small and mid cap dilemma. Experts advise caution. Okay. So it here there's a chart here talking about mutual fund inflows through into multi-cap, large and mid and small. And in spite of the heavy volatility, in spite of the overvaluation, the flows into small and mid caps are more than the flows into large cap. It should be the other way around. But it seems to be that the propensity for taking risk by Indian retail investors is pretty high, and in spite of the higher valuations, they are willing to put in more money into small and mid cap mutual funds, who will then have no option but to buy more of these small and mid cap stocks, boosting up their prices and valuations even further. Why am I saying valuations even further? It is because earnings growth last year in the small and mid cap has not been as good as expected. Their forward price earning multiples are between 28 and 31 1 year forward, but earnings growth is nowhere close to this kind of rate of growth. And this disappointment should hit at some point of time, but I guess that either it requires a scare or it requires liquidity in the hands of people to come down before they realize that they're buying overvalued stocks. So yes, as the head experts say, caution is advised, and one could do better being in large cap rather than mid and small cap, as this article says. And yes, I tend to agree with what they are saying here. Okay, this interesting thing happening with Power Finance Corporation. They've been trying to raise bonds, issue bonds since the last few months, and more than once it has so happened that they had to withdraw the bond issue. Why did they have to withdraw the bond issue? Investors were demanding a higher rate of interest than what PFC was willing to offer to the investors. This is strange, don't you think? Obviously, somebody issuing bonds will be wanting to pay the market rate of interest. Why are they wanting to pay less than the market? They have been apparently pricing their bonds at lower than the 10-year GSEC, lower than what the government of India offers on its 10-year bond. That's strange. The PFC, which is a PSU, cannot be safer than the government of India. So what is the secret here? It so happens that the Power Finance Corporation wants to issue something called a zero coupon bond. A zero coupon bond issues a bond at less than par value. Say a 100 rupee bond will be issued at 90 rupees, for example, and on maturity you get back 100. So you invest 90 and on maturity get back 100. It does not pay out any interest quarterly, semi-annually or annually. In lieu of interest, you get a maturity value which is higher than what you have invested. So the risk is rear-ended. When you're earning interest every year, the risk keeps coming down because you're recovering your money. But here it's all rear-ended. You all get your entire return at the end of 10 years. So it is likely that investors see the risk higher because there are no returns upfront and all of it comes at maturity. The second issue, what PFC was bargaining on, is that the gains that you make on the maturity of the zero coupon bond is counted as capital gains, taxed at a lower rate than interest. Interest is taxed at the marginal rate of interest, at the marginal rate of income tax that all of us are subject to, whereas capital gains tax is much lesser, correct? So by issuing a zero coupon bond, they say that the investor's post-tax return will be higher. So please be willing for a lower rate of interest. But investors are not buying this, while PFC is trying to push this and saying your post-tax return will be higher. Second time or so that they've withdrawn the bond issue. They will have to come back with a fresh set of calculations. Let's see what happens and how this develops. But yes, zero coupon bonds are a great way to reduce your tax liability on retaining the stability element of a bond investment. Okay. So I think last time we also spoke about EVs and how the export restrictions by China of rare earth metals is going to impact, and we said that yes, electric vehicle production will get impacted because their stocks of rare earth magnets will run out in June, July, August, depending on each company. But there is some amount of, there's a statistic here in today's Mint. This is 3 of every 100 are electric vehicles, and 6 of every 100 are electric two-wheelers. So it's not that it's a very large component of electric vehicles that are being made in India. It's not going to impact production and turnover of two-wheelers and four-wheeler makers as much as one would have thought earlier. Okay, and the last item that I wanted to speak to you today, folks, was about silver. So why I wanted to touch upon silver separately, while gold prices have been going up because of the conflict and the war and uncertainty, silver fell. Shouldn't silver have also gone up? Isn't it a precious metal? Haven't we been saying that if gold is going up and silver hasn't gone up as much, silver should also go up as a precious metal? But today morning, silver was down by 0.34%, while gold was up more than 1%. That's strange, isn't it? One should go a little deeper into how gold and silver are used to understand this. Okay, hardly about 15% of gold is used for industrial uses. Okay, most of it is meant for jewelry, investment, in jewelry and investment. That's it. Okay, jewelry accounts for about a third. The rest of it goes in for investment. Investment by retail investors, investment by central banks, and so on and so forth. Whereas in the case of silver, it's very different. Almost 2/3 of silver goes towards industrial use, and only 1/3 goes towards jewelry and investment. So you see a very lopsided view. Silver has a more functional use, which is towards production of photovoltaic cells, production of electronics, and so on, and electric vehicles, battery manufacture. So whenever there's a conflict, like what is erupted last evening or last night, it means that global growth would fall, global manufacturing would come down because of all this, which is why silver prices fell while gold went up. So let us bear in mind that the dynamics of silver are very different from the dynamics of gold. While both are precious metals, and there is a supply-demand mismatch as far as silver goes, about 200 million ounces a year is in short supply. You're mining this much less of silver than what is required. So there's a demand-supply mismatch which could drive prices up. But if you think that global growth is going to come down, demand for silver would come down because 2/3 of silver is towards manufacturing. That could impact prices, my friends. So let's keep these things in mind before going headlong and buying silver. Keep asset allocation in mind. Don't do more than what you think is required. Don't be greedy, most of all. Okay, that's all from me. Good day.